Welcome to the Co-Host Bros Podcast, where we break down everything short-term rentals, entrepreneurship, and building a profitable hospitality business. Whether you're a host, investor, or property manager, we share real strategies, real insights, and real experiences to help you scale smarter and grow faster. Let's dive in.
Hey, what is going on, everybody? Welcome to another episode of the Co-Host Bros Podcast. My name is Matt Codd. I'm kicking it here with my buddy Austin Spitzenberger, and today we have Mr. Sam Amir, and we're going to talk to him about everything with his business and, life, and keep you guys entertained. So, what is going on, everybody?
What's up, Sam? How you doing, man?
I'm good, man. Glad to be here. Thanks for the invite. Really appreciate it.
Yeah, super excited to have you here. I listened to you speak on stage at Verma, and I think it was tremendously valuable. And once you were going over all the sales stuff, I feel like that's a great topic for our audience. Everybody's always trying to grow their inventory and stuff like that. So once I heard you speak, I was like, yeah, this guy would be a great podcast guest. And here we are. So for people that may not know you, I mean, give us a little background of kind of like how you got into the vacation rental management space and a little bit about your journey.
Yeah, for sure. So, after college, I graduated with a degree in engineering, actually, and got in the corporate world, and quickly found out that that wasn't for me. It didn't last. It didn't last more than 2 weeks before I was like, I need to get out of here. So, just started looking for other things to do. Had tried various businesses and kept throwing darts at the wall pretty much, and then kind of got into the short-term rental business in 2018, 2017-ish in Chicago. So long story short, we did lease arbitrage there. And that was like when the bubble, so to speak, was in its early stages. And then eventually, COVID happened, and luckily along the way, I partnered up with one of my business partners who was running a similar company, but the management model, so commissions on contracts. And we partnered up, and it kind of worked out because when COVID happened, Chicago died. And the Breckenridge, Colorado market that we had thrived. Obviously, people escaped from the mountains or to the mountains from the cities, and kind of helped us survive. To be honest, we kind of got lucky in that way, or we would have faced the same fate as many other lease arbitrage companies that were in Chicago. And then, after COVID happened, we really lease arbitrage is the way we grew in Chicago, and it was awesome. And then when that was gone, we had to kind of get our heads together and like, okay, now how do we focus on this management model, how to grow the management business model instead? And that's where my head was at in 2020, trying to recover, trying to get out of the hole we were in to survive, because I didn't want to go back to my corporate job and with my tail between my legs. So I started focusing on, among the other things I was doing, I was wearing a lot of hats at the time. It was a small team. But eventually we grew, and figured out how to grow organically. We are bootstrapped still. We have no invested money or whatever PE money. And we kind of figured it out the hard way, to be honest. And now we're at 550 units across 7 destinations. We're mostly in markets that are mountain towns. So Breckenridge, Park City, Lake Tahoe, Vail, Telluride. And then we do have 38 Florida, Emerald Coast as well. So it's been quite the ride, to be honest. But quick background. Most of my days nowadays are just focused on, my hats have dwindled down to just a couple now. Sales, biz dev, growth, and profitability is where my head's at nowadays.
Nice. Yeah, I think that's pretty similar to basically my role and what I do at Lazy Eight Retreats. But I want to go back. Couple questions. Where were you based out of, and like where do you go to college?
So I'm from New York originally, Long Island, New York. If you guys know New York, Suffolk County, West Babylon area. And then I actually moved to St. Louis, Missouri when I was 15, which was super fun. So opposite culture completely, but it kind of worked out. So looking back, obviously. I went to college at a small town in Missouri for engineering, got my degree in civil engineering, and graduated with a job to work in Chicago. It was the power line industry, creating, making and building substations, transmission lines, things like that, the grid basically. But which was, it's cool and interesting actually, but just the corporate setting wasn't really the thing that I was looking forward to for the rest of my life.
Yeah, for sure. No, I can relate to that. What was, like you mentioned, you did a couple other businesses until you got into arbitrage. What that maybe they didn't stick or whatever the case may be. Care to share like what were those? Like what did they look like? What were the
Oh, man,
failures?
I'm kind of embarrassed. They're kind of dumb, to be honest. But I was like 24 or 23, Um, so we were trying all sorts. It was me and my buddies. We were just trying all sorts of stuff we did a 3D printing company where we would like print out stuff and sell them on a website. Stupid. That was dumb, but kind of cool, I guess. We did something that kind of worked was an events business where we would throw events and parties. And that was actually good. And then I actually started the short-term rental on the side. And that business was taking a lot more of my time and felt more like valuable to me. So I ditched the events thing and started short-term rentals. And then a little bit of like real estate investing here and there in Chicago as well. So there's probably others I'm forgetting that I failed quickly.
No worries. Have you heard of the company? Have you heard of a transportation company called fastThe?
No. Is that
No.
Chicago?
Okay. No, it just reminds me of my backstory. So in when I graduated, I graduated from college. I started my first business too, and it was a party bus company. So we had party buses, and we would take the fraternities everywhere. So it was in College Station. It was in College Station, Texas, and we were very, very popular. We booked all the Greek events for the fraternities and stuff. So I started that business with my brother, but we were very young. It was just kind of like a thing. We really didn't want to scale it. We weren't on the same page, but I had that same venture kind of thing. Anyways, long story short, they're into this. The people that bought it, they turned it into this massive thing. And it's really
Wow.
crazy. I've been watching them and it was like probably 10 years ago, but I've just watched them
Interesting.
grow. And if you look up like fastThe on social media, it's just crazy what they built. They took basically my business plan and went into other markets and really systematized
Wow.
it, put it in. It basically is a tech company now. So it's like, I don't know. It's worth. I looked up the other day just out of curiosity at ChatGPT based on their financials. What do you think? And they were like, "Yeah, it's valued at over 30 million." And I sold it for
Holy
like 20
shit.
grand. Yeah, but full transparency, I had no like. I'm cheering for them because I would have never done what they did. Like they just took my thing and they took it to a level that I would have never taken it at because I couldn't conceive it. So, anyways, that's why I was just curious to ask that question because I was like, I had my other ventures too before getting into that.
Wild. Awesome. That's a crazy story. Interesting.
Yeah,
I
but
think you got to be more hooked into it, like more in love with it, right? So it's like you weren't as in love with it as you are now with the hospitality thing. And like the same thing you were saying, Sam, like I got a friend who does an event business, multi-million-dollar a year, but he's in love with it. He loves events. He loves that stuff. And it's like, I think you have to have a little love to be able to bring it to that level. I
Definitely.
apologize to interrupt, Austin.
no, and in all fairness, I mean, I was 23, so like I didn't know what I was doing. I mean, I just graduated from college and moved to another college town, so I just got like an extended few years to party, and it was like I
Yeah.
don't know. I would have never done that anyways, and I'm glad it didn't work out because it got me to where I'm at today. But yeah, anyways, I just wanted to ask that because that was pretty interesting. So, do you still have arbitrage units, or have you kind of phased out of that to just being full service property manager?
Yeah, we have I do arbitrage when it makes sense to, but not really. Like maybe one or two units would be lease arbitrage in our portfolio right now. But yeah, our focus is primarily management model.
Yeah. Okay. Um, gotcha. Cool, Matt. What do you got? You got something? Sorry, throwing you on the
Well,
spot
no,
there.
like I mean, no. Like, I mean, I stayed in Tahoe a lot of times. Like I told you, I used to live in California, but there was this management company there. It really sucked, and hopefully, you took a lot of their listings. I don't remember what it was. It was the only. It was like the main one, and you always had to go there and like collect the keys
Yeah.
to the house, and then you had to bring it. This is like, I guess maybe the main drag into like all the communities there, where all where Lake Tahoe goes around, but. How many units are you guys managing out there in Tahoe?
So we entered Tahoe in 2022, like fall around this time, actually, with a 25 unit acquisition. And yeah, that's when like I was just figuring out how to do organic growth and all that, like build it out. And then yeah, over the last few years, we figured it out sort of, and we grew it from 25 to 150. So we're all around the lake, so northwest, Nevada side, and also south.
So it's you and a partner, or is it? How many
So
people are involved in your guys' 500 units of managing?
so we have 120 people on staff. We've got a lot of people, and then the partners, the executives are there's probably like 7 of us total. But the way that we structured our company, like um, the 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 early employees like have equity, and then as we grew, like we gave equity proportionally to the value they provided to each level of the business. So like we have tranches from 0 to 1 million, 1 to 5, 5 to 10. If by metrics and certain results, if you contributed to getting us to that level, you got a piece of that tranche. So it's kind of weird, but kind of helped like the early days because it's so much work and it's a lot of risk. And like the guys and gals on our team are super smart and competent. They have other opportunities available to them that they could choose instead of working day and night, responding to guest questions and refunds and all that stuff. So to keep everyone motivated on the team, we kind of structured it that way. And so yeah, the core group kind of owns the company, and that kind of helps us like keep going to the next level and being super motivated. So yeah, but yeah, 120-ish of us. The way we structure our company is there's obviously a local team in each market. That's obvious, super important. You need that. And then we have like this headquarters where that's revenue management, guest services, client success, software. Those teams are all remote, and they basically like service each market. Like, so our guest services team serves all of our 7 markets, all of our 500 properties, and that's at the HQ level. So most of our employees are at the HQ level, and then we have the rest of them all in the local operation, cleaners or managers, operation people, inspectors, etc.
So at this level of scale, are your cleaners like 1099, or are they in W-2 employees, or how are you managing that between the 7 markets? So I'm assuming you have a lot of houses in each market. So
Yeah,
what is your?
it sort of depends on the market. So like Breckenridge, the cleaning providers there are sophisticated, and the facilities, the infrastructure, like laundry facilities and all that stuff, sophisticated. It's built out. So we actually don't have cleaning in house. We have outsourced it to a very high quality provider that we've worked with for the last almost 10 years. And they've gotten better as we've gotten better. Then in like Tahoe, for example, there is no infrastructure. So
Yeah,
all the
Wild
cleaners,
Wild West.
yeah, exactly. And some markets are like that. So you have to build your own infrastructure. So in Tahoe, like it is our own team basically. And we have our own facility for laundry and storage and all that stuff for cleaning supplies and linens and stuff. So it depends on the market, but I would say most of the cleaning side of it is contractors. And then a few markets we had to build out the infrastructure ourselves.
So when you built the infrastructures in those markets, are you using that infrastructure to service other other short-term rentals besides the ones that you guys manage, or are you guys trying to make profit off that at all, or just in-house?
It's in-house. We've thought about it, but we kind of want to focus. We go back and forth on it, but at the moment we're like super focused on just making it for our company and not worrying about making it a different business, basically. And having clients with cleaning would be a whole different thing for us. So we're kind of just focused on our own stuff.
Yeah, I was just curious how you do it at scale, because I mean, you guys have 500 properties, which is like astronomical. So what was the goal when you were going? Did you ever think that you would be at the level that you are now?
No.
Or what was like the goal at that time? Like,
Oh man. No, not really, to be honest. It wasn't like a master plan. Like the plan has always been to build something of value and then eventually reap the benefits of that. We just didn't know, like we just showed up to work and try our best every single day. There wasn't like this 5-year plan or whatever. I mean, we have obviously conversations about like the next 5 years, but yeah, we're just yeah, super ambitious and very hungry, and we just show up to work every single day, try our best, and we're hoping it works out. I think we're doing the right things and always learning new stuff. Even from Dharm today at the conference, I've learned a couple new things. So, um, we're just focused on the present more so, and we've got a few goals in the next few years that we want to hit as far as like metrics and numbers go, and we'll see where we end up.
Are you at the conference now?
Yeah. Yep.
Oh, okay.
That's
Okay, gotcha.
That's
Yeah,
why
I
he's
was
in Florida. Okay.
yeah,
Yeah.
I was looking at it. I just decided not to go. I'm gonna go to the other one coming up. But anyways, what I was gonna ask is, oh, do you find people at your level, like we're at 65 vacation rentals, and we're navigating this. We're probably 80% of our listings are in one market, and the rest are in another. So maybe looking at your portfolio, probably 10% of the size of you. But do you feel like bringing laundry in house makes sense? Is it a profit center? Is it worth doing it? Right now, we're very streamlined where we've got this just vacation rental management operation. We do one thing and we outsource our cleaners, kind of like you do in certain markets that you said. But do you think do you think that it's like it's worth entertaining? To me, it's like, man, this is a whole new business we've got to explore. And
Yeah.
is it profitable? Is it worth doing? At what level is it worth doing it? I don't know. Do you have any experience on that?
Yeah. I would ask a couple things. So like, is, like, let me give you like an example of Telluride. Okay. So in Telluride, there is no infrastructure pretty much. And the one company that is good charges ridiculous rates. And in the beginning, when we first entered that market, like it was just too much. And I'm glad they can charge that much. That's awesome for them. They're making tons of money and I'm happy for them. For us as a business, like can't do it. So we were like forced to build our own infrastructure because we had to solve that problem and not have like cleaning fees so high that it would affect our booking rate and conversions. So it depends on the market, I would say. Like if there is competition in the market, that's a good sign that there is demand, obviously. But is that competition like, are they fair? Are they charging like what you would say fair rates is one? So, and then also like, I guess your goals too, like, do you want to do it? Because if in Telluride, like our team could start our own cleaning company and I think we'd make a lot of money. We just like know that's an entire commitment and it'll distract us probably a little bit. And we got to hire people and labor's tough there and stuff. So there's a bunch of factors I would say, but one is like your goals. What do you want to like, do you care about the management model? Like, what do you care about? I guess what your goals are. And for us, it doesn't make sense 100%. And then also like look at the competition. Is there competition? Is there not? Is there infrastructure like laundry facilities and providers? If there is not, like how close is the closest one? Like in Big Sky, Montana, for example, there's no laundry in Big Sky. You have to drive 45 minutes south to Bozeman and run back to Montana, Big Sky. Some companies do that. So like again, we're forced to build our own infrastructure in Big Sky to service our own properties and not have to drive and pay someone to go back and forth or pay that cost with a contractor. So it kind of depends, Austin. But there is money in it. I will say that if you do it right and you find a good market where there's demand, there's some good money in it for sure.
Yeah, I think you named like 4 or 5 factors that I'll probably honestly just have to deep dive in because the rates from using these professional cleaning companies, they're pushing it like it's borderline outpricing the booking. So it's
Yeah.
like it's something to entertain. My partner also used to own a cleaning company, so there may be something there. But then also like we're trying to grow in other markets as well. So like to your point, you made a good point earlier. So like, is it a distraction to start building a laundry service in this area where we're growing into other markets? Like there's definitely we're discussing it, but I think it'll eventually reveal itself and we'll know. But for now, I think we're just kind of toying with the idea. But I do want to change the subject real quick. Like, I want to talk about something that you said in the beginning. Your main focus was on sales, business development, increasing profitability. Um, Run me through that. Like, what is something that you're doing to maybe increase profitability, or like give me something so like along the way, maybe I can look for these things to make us more profitable as well.
Yeah. So yeah, a couple things. One is the issue of price floors with owners. So, my opinion on price floors is that, Yeah, the argument that owners always have is that they know what their home is worth, and to a certain degree, I can't blame them, and I kind of agree in some cases. However, what we found in our experience is that when you let a competent management company or manager who understands the market and has good guest vetting policies and all that stuff, if you let a competent manager dictate rates, you actually make more than enough to cover the wear and tear that may come from lowering the rates, like in off season, for example, or under a floor that the owner has in their heads. You actually make more money. In fact, you make enough money to cover utilities, and you make enough money to cover your daily costs or whatever, in addition to wear and tear. Because as you guys know, like the more bookings you get, the more momentum you get, the more reviews you get, the higher rates you can charge. So I try to have my team pose the floor thing to owners as an investment in their property. Like, it's kind of counterintuitive. Like, what do you mean by that? I'm not going to take a listing or booking at $200 a night for my awesome home. And I'm like, I get that, but doing that will get you momentum to get better bookings at higher rates in the winter. Like, you're making an investment, that's a loss. You may lose money on that booking as far as utilities go, but you will make way more money in 3 months when you have momentum. We can charge higher rates because you'll go up in the rankings on Vrbo, Airbnb, et cetera, and you'll get booked. So we're doing like a heavy push on our team during onboarding to educate our owners. And because I think what the price floor thing comes from is like, they don't trust you. They want control because they don't trust the person they're giving their keys to let the guests in. And so it's all about building trust up with the homeowners and saying like, hey, just let us do our thing. We're experts. And if they push back and they're like, absolutely not, it's their home. So like, it's okay. But we will over time try to, again, build that trust and break that barrier down. Like, give us control, see how it works. We might offer like, hey, okay, you may not give us full pricing control, but how about a temp floor? Like, how about like a temporary discount that we can offer for this period? And so it's not for the whole winter or whatever or high season. It's just for the fall. So little things like little baby steps to like full pricing control, for example. And then, so that's like one big thing that pops in my head because it's what we're working on right now. And we made a lot of progress on, honestly. And then education with the clients. And then furthermore, like continuing education by, we recently shifted our account management team to actually focus on account management more than just like the random phone call a homeowner will give and be like, hey, there's a random expense on my owner statement, or can you put this owner statement in for me? That's like all low level, like not really an account manager's like responsibility in our opinion. So recently shifted that low level work off their plate so they can focus on what they're hired to do, which is account management. So making sure that the properties are hitting projections, the reviews are great, the maintenance issues are minimal, et cetera, homeowners happy. And part of that like hypercare proactive communication has been doing quarterly reviews with the homeowner. So we'll invite them, we'll put a sweet deck together, presentation on how the previous season has gone and what's ahead. What are we doing at local VR to make the service offering higher quality? So, hey, we're on Amex now or whatever. We've made this cool improvement in the owner portal that we've built in-house. Check it out. And then also going over their reservations, their reviews, any competitive advantages that we think they should invest in their property for. And again, so all those things develop trust. And they're like, you know what? Okay, fine. I think you guys are competent. I'll let you guys do, what you think is best. So that's been a huge push. It's like a really leveling up our owner experience managers and giving them a lot more tools and time to build that trust up with homeowners. So that's a major push. And then also just like getting down metrics, really, really dialed in. And it's a lot of work, but we've got a model that kind of figures out how much each property costs at a unit level for us to run. So like all the guest services tickets that come in and the refunds we give out and the maintenance issues that happen at the property, like you can quantify that in some way. It's not perfect, but it's something. And that gives you a cost per property. And so we take the revenue that property has made the last 12 months, look at the estimated cost of that property based on like how many guest services tickets there are, how many times the owner has called us, et cetera, all these like different cost variables. And we get a net number. And then we focus on, okay, well, this unit isn't doing so hot. Like I wanted to make X dollars, it's not there. What can I work on with the homeowner or with the revenue management team to get it there? So we make a little plan for each unit, each property, and that might be owner usage, right? So like we might have to call the homeowner and be like, hey guys, like you guys are just it's not making sense for us as a business to manage your property. You're taking away 2 months of winter. That is our high season in our ski markets. Can we work together on that? Can we be flexible on that and give us some of the weekends back? And if the pushback is clear, like they know, like we want, we like love to ski, it's a family home, etc., then it's going to be a tougher conversation. Like, oh, wait, we got to raise management fee up or something, like charge you a monthly fee or something to make it worth it for us to manage that property. Because every unit has hard costs. Our inspectors go there to check on the property every week, etc. So yeah, does that answer? I could go deeper on this, but that's kind of like something we're working on.
So I actually I wanted to go like to the point you made about the account executives. I think that maybe a lot of people won't see how what you're doing, and I might be seeing it wrong too, about what you're doing by making the account executives the actual doing their job. And the way I look at it is that you're doing it to increase retention, increase lifetime value of the customer, which increases more money. But that's the way I'm looking at it. And maybe I'm wrong, but I wanted to, if that is correct, I wanted to make sure we kind of broke it down for people who aren't thinking on, the 500 property level, right? Because you're over here tracking KPIs. Most of us are like, let's just find the next one. You know what I mean? Let's find the next client.
Yeah,
So
that's a good point. I'll dig in a little deeper to that. So like, as you grow, the questions that a lot of the questions a homeowner asks can be answered by pretty much anybody if you have a way, resources built out for that person to answer it. So like, again, enter my owner's day in, or hey, can I, and we have our own portal, but people will still ask us. So like, hey, like, what do you think about, you can change my owner's day to, you guys cleaning and not us or whatever. Or they'll call us and ask some like minimal low value thing that anyone can answer. And what we noticed was like, we were more so responding to reactive questions versus being proactive. And proactive stuff is what retains the client, not the owner's day change or whatever. Why is there expense on my owner's statement like this or whatever? So we were just getting like bogged down by this reactive communication that just didn't make sense. And we were getting away from what we used to do at 100 units, 50 units, which is proactive. And so, it came to a point where like, okay, we need to figure this problem out because our people, we pay them a lot of money and they're just answering the most low value questions. And it's like, we can't have that. So how do we figure out how to split that apart and really focus the communication stream to the questions that the account managers get asked, the local owner experience managers? It should be like super high value, like meeting a homeowner in person, for example. If they're answering questions for 50 people that are super low value, they don't have time to drive out and meet a homeowner before their owner's day, for example. They don't have time to put a deck together, a presentation every quarter for 50 people, one by one, about how their property has done in the past and what we think it's going to do and like reviews and how to improve it. They don't have time for that. But that stuff is what matters, in our opinion, at least. So yeah, we found a way to like split that. And we have like a system now where there's basically a filter where the questions come in and then it gets filtered. So if like it's low level, this team will handle it. And they're super competent and they have resources to answer the questions. And if they can't answer it, or it's an escalation, or it's not appropriate for that team to handle, the owner experience assistant team, it's going to be the managers. And again, that we've like flipped the ratio of like, okay, well now it's like almost 90% of the communication is coming from us to the client versus the opposite, which it was, 8-12 months ago. And it's just been a huge shift. And again, like at 100 properties, like it's manageable. You can answer the low level questions for people and still be proactive. But as you scale, like you just get inundated when you start drowning on these like lower level questions. Does that make sense?
Yeah, no, it does. I mean, I like the way that you're explaining it because I think you're just explaining more structure wise too, and things for people to think about, things for like Austin to think about. and what they're doing. So are those low level questions, are they getting filtered automatically, or they're just going to like the lowest level possible? Like, hey, if you guys can answer this, you need to answer this. If you can't, send it up to the next party. Is that how you're doing it?
Exactly. So if you ever used if you ever used a Zendesk or like any business B2B like customer service thing, ours is not like that as far as people all over the world, and like it takes forever to get responses. It's a little more like local here, but yeah. So like the call or the SMS or the email will come in through it's all hooked to Salesforce or CRM. So the message, whatever communication method it is, comes to through Salesforce to our owner experience assistant team, basically. And then they will screen. So like if it's a phone call, they'll screen on the call and be like, hey, this is whoever, like, what can I help you with? And if it's for the account manager, they'll forward it, they'll escalate it. If it's an SMS or email, a little easier. They can read it and be like, this is not for me. I'm going to escalate this. They'll hit an escalate button on Salesforce and it'll escalate to the owner experience manager.
Yeah, I've used Salesforce before, so I'm familiar with that. But yeah, that's super cool. So what other things do you guys, or for instance, like what other things can somebody implement as they grow to increase profitability besides just raising commissions or charging a monthly fee for like lower level performing properties? Like what would you suggest that somebody does to increase revenue in their business?
Yep.
Just, starting out. Let's just say they go 10 to 50, something like that.
Yeah, well, yeah, obviously, yeah, price floors, talked about that a little bit. And then one thing is it might be it's a little easier at 50 or 10 to 50 to do this. But you give projections to a homeowner and you think they'll make some amount, let's say 100 grand or whatever in the first year, or when it's ramped up or whatever. The issue is like in the first year of working with someone, you're not going to hit your projections because, it's ramping up, like you got to get reviews and blah, blah. And one piece that gets a little complicated at scale, but is easier to manage at lower levels is the ramping up part of the listing. So it's hard to manage the ramp up of each unit at scale, but like you could totally do it and make sure that you have momentum and you're not falling out. So that's one thing I would recommend is keeping a close eye on review to reservation ratio, for example. That's an indicator of ramping and where you're at, right? If you don't get a couple of reviews in the first few months, you're going to stall out potentially. So keeping on that metric is important. Obviously, making sure your guests are happy, give you 5 stars is also important. Where you're at on Airbnb and Vrbo, like where in the search rankings you're at, also matters. So keeping tabs on that and making sure you're getting close to the first page. So keeping tabs on those metrics in the first few months, as well as bookings, obviously, is going to help you, because oftentimes like you'll go live when it's dead, right? Because most people switch management companies when it's like, and that's not good for bookings because no one's booking. So
yeah, it's the worst.
Yeah, you stall out. So you got to be a little bit careful, like timing of going live, and then monitoring that listing and making sure like you can get it ramped up so you hit numbers, because if you don't hit numbers, your owner may churn. So that's one thing I would recommend as well, keeping an eye on ramp up, and you can do that at 10 to 50 pretty easily, I think. And then, I think one of the other things is like keeping tabs on leaks is important. So like money leaks. So maybe more like you make money by not losing money kind of thing, but just keeping a really close eye on your cleaning margin. For example, we don't make money on cleaning. We just make enough to cover like our costs. So we'll make a little bit on each to cover supplies or things like that. But you want to make sure that whatever system you have is accurately tracking the cleaning cost, what you're paying out, because when you get invoices from cleaners, they can be a little messy, that's the least. So making sure your accounting is super tight in that regard, as well as like making sure your accounting is tight in other areas. Like, are you paying the right amount of commission to Vrbo or whatever platform, and you're charging the owner for that much or whatever. And it's accounting in this business is very, very complicated, in my opinion, at least. And so in the beginning, we definitely made some mistakes, but not even realize we have money leaks. So because the more cash the more money you can have, the more you can shovel back in the business and grow, which is what we've done. So we've like invested a ton of money in the business, all from growth. So the more money you can retain, obviously, the more you can do that, and obviously increase your service quality as well.
Yeah, that's awesome, dude. I wanted to talk about you going from 0 to what 550 since what, like, let's say 2018, right? So like 7 years. Let's say that. Okay, cool.
Yep.
So 0 to 550 and then in multiple markets. So I guess my question is like, what was how did you do that? Like, what was the main success point? Like, I heard you talk at Verma about the 5 things. I'm doing the 5 things. What was, like, maybe what's your top two? Like, how did you get such explosive growth? And then once you also went into a new market, how did you how did you get growth in that new market? Because it's really hard to get momentum. Like in the Texas Hill Country, that's where we're at, right? So we dominate here, no big deal. But we're trying to grow on the Gulf Coast. But it's hard to get that momentum going of, like, people are like, we manage like 10 listings, so people don't really know who we are, I guess. So anyways, my main question is, how did you go from 0 to 550 in such a short amount of time? What was the big needle mover in the sales process?
Yeah. Couple thoughts on this and try to make sense, try to make it make sense. But one thing, just to give you some background, we did do acquisitions, just to be clear. It was our own money, of course, and we were very, very careful. But so we entered Park City with an acquisition, about 40-ish units or something like that in 21. That was our first one. And just, yeah, and then even more background, like, how do we do that with being 27 or whatever? Well, first, Breckenridge made money, and we had enough saved up to spend, and we wanted to grow. So like we made the jump to, well, we want to keep our kind of vision was like going to more mountain markets like Breckenridge. There are awesome ski destinations. I have Vail Resort there. So we picked parks. We picked Park City, and I was reaching out to management company owners. I was just cold emailing them, really. And it was 2021. And then we found an operator who we got lucky, I guess. She responded to me and she said, yeah, I'm looking to exit, but I don't really want to like go to a Vacasa type company or whatever. They'll obliterate my clients and all this stuff. So it kind of worked out. So that happened in 21. That's how we got in touch with that company owner. I was emailing a lot of people, cold emailing, and it just kind of hit. So that's our first acquisition. Lessons learned there for sure. Entered Park City at 40-ish units. Same thing in Tahoe, 25 unit acquisition. This one kind of found us. We didn't actually look for it. But I actually love Tahoe and I wanted to go there. I just didn't have an opportunity. And this came to us. A business broker called us. I picked the phone up and I was like, hey, what's up? And she was like, yeah, we're representing a company in like Tahoe that wants to sell. Are you interested? And I was like, yeah, I'll check it out. So kind of lucky in that regard. So both those markets we entered through acquisition. And then for us, we always like looked at acquisition as like we didn't want to put all our, first off, we had no money to like put into acquisitions and buying like tons of companies. We're bootstrapped. So we always looked at organic growth as like a complement to acquisitions. And the strategy for us has been enter the market with certain markets with a small acquisition to have credibility. You don't need to enter a market with 200 units or 150. You can enter with 20, buy a small company, and that gives you enough credibility to go to a sales call or meeting a homeowner. And when they're like, how many properties do you manage? And you say 20 instead of 0, they might close. Like you have a pretty high chance of closing them because they don't really care too much after 15, I think is like the intuitive number, but 0 they care about. So going to owners with 0 is super, super tough to grow organically. But if you go in with 20 or 25 or something like that, like it's a much easier conversation. And also you can offer them like super boutique level service in the beginning. So yeah, we entered Park City and Tahoe that way. And then we leveraged our small acquisitions and grew from there. So that's how we've done it. And then we've over time, like refined the organic growth engine so that we could go to new markets without having to buy a company. So what is organic growth engine? I said this earlier today at the conference, but it's 4 components. First is lead generation. The machine consists of 4 components. Lead generation, so figuring out which properties are short-term rentals, who owns them, how to call them, how to contact them. The second piece is like, once you have that list, where do you put them? That's your CRM, the central brain. And then once you have in your CRM, what do you do with them? And that's like building your CRM out to have some sort of organized fashion of moving leads to the pipeline, stages, cadences, automation, et cetera. So that's the sales tech stack for us, at least at Local VR. We built that, and then you'll hire great people that can use the machine with tons of leverage, because they're not doing lead generation. They're not doing like worrying about their pipeline and task management and follow-up management. Like, I've done that all for you with the CRM. So like, you give them this super sweet tool they can leverage. And you just, so if you've done all that work in the back end and you go to a market, like, organic growth becomes much easier. It's not a slam dunk, but it's a lot easier, I would say. So we like refined that organic growth engine, and that's how we like have grown from in each market. Now, what I've learned over time is that in actuality, each market has its own like launch playbook. Some markets, you don't even want to try organic growth. It's not going to work. Like Sedona, Arizona. I tried, does not work. You have to enter Sedona with an acquisition. There's no other way to do it if you want to like not be in a hole for like 2 years, with payroll and stuff. Like, you can do organic growth there. It'll take you a long time to grow and get like 5 units there. It's just different. So some markets, like, you kind of have to understand the market a little bit before you go and do some research, so you can pick the right strategy. You may want to enter organically, or you may want to enter with acquisition. It depends on the market. So some research is required. So like, before we go a new market nowadays, we'll like do some heavy research beforehand, and then we'll pick the right method to move in. And then we'll try to, if we can do an acquisition to get into a market, we may do if the deal is good, but we prefer not to. So like Vail, Telluride, these are markets where we entered with no units. We just moved someone there from our team actually, and after doing some research and looking at the competition and stuff and thinking, I think we're better than these companies. We just have no units here. So let me just move someone over here for a little bit so they can grow the operation and have a local presence. So yeah, a couple scattered thoughts there. As had a thought and I'm losing it. It'll come back to me. But I hope that kind of answers the question.
Yeah, no. So it sounds like even the markets that you're in, like, it almost sounds like it was unintentional, where it's like things just kind of fell this way. And like, maybe this market that you're in 7 markets, you're like, I wasn't even thinking about it, or maybe like that acquisition kind of came to you. So you basically just went to these markets. Were you just like looking around everywhere? Was it like just, hey, who has the best kind of units? Because you didn't buy 40, slumlord units, right? So like, I guess my question is like, it kind of, you know, accidentally took you into some of these markets, right? Like, is that kind of how you did it? Or were you like saying, hey, I want to get into Tahoe, I'm going to acquire someone right here?
Yeah, no. So those acquisitions was the only acquisition we've really done. We did one in 38 Florida as well. But that was more intentional, I would say, 38 one. But we didn't enter Vail, Telluride, or Big Sky with an acquisition. It was organic. But yeah, like for Tahoe, that was sort of luck and opportunity. Like we did have to compete to get the deal done. So there was like some sort of work required. It wasn't like totally lucky, I guess. But like Park City was like, I didn't really know what I was doing. But to be honest, when we first like thought about going to Park City, I just thought I was doing the right thing. And so, and then once we like did Park City, the model kind of proved itself, I guess. Like, if we wanted to grow through acquisition, I would have to go to different markets, figure out who to email, how to contact them, call them, and reach out and try to see if they're interested in selling, have a conversation, due diligence, et cetera, and go from there. But it wasn't, I don't want to say it fell on our laps, because there was like, it's not all luck, but in some ways true. But now, like, we're a lot more intentional now, I would say, Austin, like about, like, we know a lot now we learned a lot from those experiences. So we're like, now we have like the insight to know whether to do how to do an acquisition, what markets deserve like when we did Park City, we didn't know that you couldn't organically grow there. We kind of knew, but not really. We just liked the market. We're like, this is a super sweet market, and it mirrors Breckenridge. We know how to operate in Breckenridge, same operational complexity as Breck. we want to go to Park City, super sweet units, Sundance is there, etc. And that's kind of all we had, honestly. It was kind of like a little risky. But nowadays, like, a lot more research goes into picking a market. So we're doing tons of research. Like, we'll even go into like regulation is a huge risk. Obviously, you want to make sure you got that locked before you enter a market. This is a huge risk to your business. So we'll like research like town council members and like who they are and what their politics are and things like that. So we'll go that deep before we go now. When we hit Park City, we didn't do that. We were just 26 or whatever. We're like, this is cool. So a lot more thorough now. We have a lot more metrics we look at now before we enter a market to pick the right market. So it's a lot more sophisticated now than it was, for sure.
Yeah. Do you know Patrick Switek by any chance?
I don't.
No? Okay. He's been on our show like once or twice now. He has a company in Joshua Tree. He's done 3 or 4 acquisitions, and he came on here. He's all in one market specifically. So you're a smart guy. Obviously, you're building this thing to sell, whether you want to do this in the next 10 years, 20 years, or you want to sell it in 5 years, whatever the case may be. I know you're thinking long term, like, hey, I'm at least going to build this for an exit, right? So I guess my thing to you is like, what are your thoughts on? Have you looked into like what is being in 7 different markets? How does that affect maybe like your valuation? Are people interested in buying something with management branches all over? And I mean, I'm sure they are, but I don't know. Like, what does that look like versus just being, you know, the biggest and baddest where you're at? I don't know. 500 is a lot to be in one area in any vacation market, I feel like, but I don't know. Does that question kind of make sense? What I'm trying to poke at?
I think so. Yeah. We'll see if my answers kind of make sense. But yeah, multi-market does make a difference in valuation. You get a higher multiple. And it's because of a couple things. One is like risk is less spread out, obviously. Also, like there's a lot more growth opportunity. So for example, we entered Big Sky in August of this year or something, or late August. We're at about 15 properties now. We'll be at 20 in a few months probably. So kind of slow, but yeah, like Big Sky is a massive opportunity. That market has the potential to be another 100 to 150 unit market for us over time, of course, right? So as you get into like picking the right markets is huge. Like I don't want to go to like some random city in Kansas, for example. I'm picking the right markets where there's demand and like fits our brand and all that stuff. Where the property quality is high, revenue per property is high, ADRs are high, et cetera. So picking the right markets and collect, and then, it's basically like building a portfolio of like for us, the vision is like picking the right markets where there's high value properties. So we didn't it just turns out that the mountain markets have super awesome properties. So that wasn't like our vision in 2021 or whatever. It was now it is, but like back then it was just like, this is a cool market. We want to be here. But now it's like, we're very intentional. So we pick markets that have high revenue per property, properties, high ADRs, the risk and regulatory is low, et cetera. And again, you reduce your risk because you're spread out across multiple markets. So if one goes down, like you're not destroyed, it would hurt. And then also the growth opportunity is, if we can make, like we have 150 in Tahoe, 200 in Breckenridge, if we can get more of those kind of like big markets, depth in each market, that's how you get to 1,000. And we're not looking, so, 1,000 with 7 markets is manageable, in my opinion. It's not manageable with 20 markets because it's just like you're too, or like, all over the place. Like it's just too hard. Like we want to be like concentrated and dense in specific markets, and also allows us to like become the best company or strive to be the best company in that market as well. If we can like focus. So we're not looking to be in like a million markets. We're looking to be in just like selective markets that we like, and then becoming super deep in those markets. And yeah, I think that the investors out there, the PE companies, VC companies, or people, other bigger management companies like to see that you can operate in multiple markets for those reasons. But also, in order to manage in multiple markets, you have to have some sort of centralized system that can do so, right? So I talked about earlier, like our company's like structure a little bit. So we have a local operation, and then we have headquarters, which is like the team and the departments that service each, because you don't want to have like revenue management locally. It doesn't make sense. You want to have that centralized, and it serves all your properties amongst all your markets. So the more you can like, the other, more markets you have, obviously economies of scale, but also that's certain, it lowers your cost per unit significantly, obviously, which is also huge. But yeah, you increasingly become this like super structured, centralized structured company, whereas a hub basically. But in this business, you want to forget the local operation is like the most important thing. So the hub is awesome, obviously, but local ops is huge. So, and they like to see that too. I like to see like, oh, this company has a system, some sort of structure in order to manage 7 markets or multiple markets. They have something centralized that can do that. That's appealing to us. We don't have that, or whatever, you know. Hope that.
So when, because a lot of people, you know, are they listen to the show. Some of them are starting out, and some of them, you know, are growing. So when you're looking at a market to move into, like what kind of indicators dictate between organic or acquisition? What is the deciding factor?
Yep, it's gonna be competition. So that's that's a big one. So we once we like narrow down the markets based on like just revenue metrics, so ADRs, property quality, etc. Once we have a list of those markets, we start doing research on the competitive quality in the market, and also we look for like moats. For example, like Big Sky, great example. There is no cleaning infrastructure in Big Sky. Now, what does that do? That will scare a lot of people. In 38 Florida, there's a ton of sophisticated cleaning companies and laundry facilities, and the infrastructure in 38 Florida, the Emerald Coast, is amazing. We could never replicate what they have here. So we're not going to even try. We're not going to ever try to build our own cleaning company in the Emerald Coast, because there are better people that do it than us. So we'll just hire them instead. But in Big Sky, that does not exist. Now, what happens when you have no infrastructure? That's like a inherent competitive moat. Only the people that want to go through the difficulty of building cleaning infrastructure will enter that market. The people that don't want to do that will filter out. So like, it's an inherent competitive moat. We look for that because we're good at building infrastructure. We were a cleaning company at the beginning of our company. So like, we know how to build a cleaning company. It's a management company made more money. So we look for that. And then again, like, whether it's a competitive mode or not, what does the competition look like? So are there high quality service players in the market? In 38 Florida, what we learned was there's a lot. We are in a very competitive market, where the race to the bottom in management fee percentages is a thing here, unfortunately. Whereas in our mountain markets, the management fees hold up. There's not a ton of competition. There is competition. In some markets, the players aren't that good. So we do a pretty thorough like research on the competitive set of the market. So we'll like look at their websites. We may call them to figure out what they're charging, how much they charge, if they use any technology. And you can get a pretty good sense of the competitive market right there. Also, looking at the reviews and stuff like that will also be a good indicator of competitive quality. But basically, like, if you're a good company and you offer a high quality service offering and you enter a market where there is just no one good, you can do organic. It'll work. There's no need for an acquisition. You don't need to spend $500,000 or whatever to buy a company. Hire a great salesperson, hire a great operations manager. That's, way less than acquisition cost, and they will do it if they're trained properly and hungry. But then like other markets like Park City, there's a lot, like 30A as well. There's a lot of awesome competitors here, super high quality. And so the only way to get bigger fast, to us at least, is you have to do an acquisition. Again, you could spend like 2 years or 3 years or 4 years doing organic growth. It's just going to be a long, long grind. You'll be in the hole for a long time, especially if you're bootstrapped, right? So, and you don't have like outside capital. So yeah, competition is huge.
to the companies. Or if the companies are too good, then you probably want to acquire. And if they're subpar and you know you're better, you want to go the organic route and kind of use their shittiness against them, I guess.
You got it. Exactly.
So,
and then like you're doing a service to the homeowners. Like in markets where there are no good management companies, like that's not cool. Like there should be a good service provider that can come in and actually help people manage their properties. And in some markets, like that's lacking. So if you come in and you're just like way better than anyone in town, we've had homeowners who like left our company in certain markets and came back to us because they shopped around, they hired someone. They were like, that you guys are like way better. We didn't know what we had. I'm sorry. Can you take us back? And that's great to hear. Like, that's awesome that we worked really hard on the back end of the operation to make it super high quality. So yeah, exactly.
did you get a raise on those?
You're damn right we did.
You're like, yeah, we can, but it's going to be a few % because it's a little bit more of a
You're damn
hassle.
right.
Yeah. That's what you get, Janine.
Yeah.
I did have one more question. It's been like an hour, I know, and there's so many questions we can ask you, but you're like a numbers guy. You're a KPI guy from what I can tell. So what's the cost per acquisition, man?
It's about 4,200 something or so.
Dude, that's great.
Something
that's
like that.
Great. That's great.
Yeah.
That's like what, like a 10th of your lifetime value? Not even. That's great.
It's more. Yeah. It wasn't like that though, man. It's a lot more expensive. It's just a lot of hard work, to be honest. Like, and it wasn't just me; it was like a whole team effort. So I can't take the credit at all. But yeah, we worked really hard, and yeah, I think we've come a long way. So
yeah, that's super good. And for like those who don't know, like if your cost per acquisition is what you're making in a year, it's good. So if his cost per acquisition is $4,000, like spit on me, call me Sally. Like, my God, that's great. That's great.
Yeah.
Wow. Killer.
Thanks, man.
Yeah. Austin, I don't have another question on that one, but I'm too impressed with the cost per acquisition. So
no, I think I'm good, man. Sam, I appreciate you coming on, and that was tremendously valuable. Are you speaking at the conference today, or did you already speak? Or
I did, yeah, earlier today.
What'd you cover?
We had a panel with Away Day and Monarch, and Jacoby at C2G was a moderator, and just talking about like organically growing. So I'm kind of using the same kind of spiel at that panel. Yeah.
Would you recommend that one? I skipped it just because I just went to VRMA and I was like, I don't feel like going right back to another conference. I hadn't been to that one, but would you recommend that one compared to VRMA? It's a more data driven. What's your insight?
I like DARM. We had two of our, like, we had a software guy, one of our software director, engineering director, and revenue management director go last year and check it out. And they loved it. And they're like, you guys have to go next year. It's like legit. And then, yeah, so this time we got invited to a panel. So I went, and I think it's actually like a little higher quality. The people here are a little bit different. They're a little more, more executives here. It looks like decision makers. It's a little, and the layout's different too. I would recommend DARM. And the ticket's not that bad actually, compared to Verma.
Yeah, I'll have to go next year then. You're selling me on it, so I'll have to
check it out.
Do it next year. But
I do want to ask one more selfish question. Actually, I apologize. So when you were hiring, when you decided to hire a revenue manager for your company, right? Did you train them in-house, or did you hire them from the outside? And what determined the factors on how you decided to pick them?
We did hire from the outside. We hired our director of revenue management. Actually joined the company in the early days. He's one of the partners and a really good friend of mine. And so we were, both went to college together. So it kind of like worked out, but in any case, like, not because like he was my buddy, because he had the traits required to do revenue management, which is a very like, it's more of an art than a science, but also science. And you want a nerd. You want a nerd who understands data and how to look at analytics and understands technology. And also like, yeah, we thought like the people in the industry were a little used to a way of pricing we did not agree with. And maybe we're wrong. I don't know. But we just thought the way that certain people did pricing wasn't correct. And so we kind of wanted someone that we could develop in house. So our current director, John, he didn't have any prior experience, but he had the fundamentals. So super smart, data driven, analytics, gets in the weeds, understands how to use spreadsheets to a ridiculous level. And he helped build our pricing software that we have. It's on our own stuff, but he helped like build it with us. So we needed someone like kind of different scope of skills, I think. So it kind of worked out, to be honest. He just happens to be my friend, but he met the qualifications that we were looking for. Now, as we've grown, what we look for, obviously we don't, I don't have any more super smart friends like that, unfortunately. So we have hired underneath John, and what we look for is, the same kind of qualities, but they don't need to have like the vision for like building out a software, for example, but they have to have understanding about like, when you, how to like, they have to look at they have to know how to set the rates in a way that makes sense. Obviously our software will do a little bit of the work, but it's not going to be perfect. No software is, no matter if you're using Beyond or Wheelhouse or Price Labs. They're all going to get you some part of the way there. And then we need someone that can look at a bunch of indicators and metrics and dashboards and figure out how to tweak the pricing so it actually makes sense. And that human element is so important with pricing. And that requires like someone that understands how to use a computer to a very technical level that's required. And then again, like analytical, we give assessments during interview process to gauge your analytical level and how they understand like math and pricing and stuff. We're engineers, so like we're super nerds. So we look for that in revenue management. Just a super math nerdy. Don't got to be amazing at talking to clients. You don't have our rev man people talking to clients most of the time. The account managers to do that. So that social skill set's not required. You can be a super nerd and just focus on optimizing rates all day.
Probably they don't have social skills. You're probably on track. No.
Exactly.
Sam, like what surprises me about you is, and like maybe I'm putting people in a box, and maybe I'm stereotyping here, but like it seems like like from what I've met from engineers, which I find is unique about you, is like you seem like you have this vision that you have like 10x, like you're able to take action, massive action over and over again. And what I see about engineers is they're so analytical that they just keep getting in the weeds about what if, and perfectionism. And then it's great in certain areas of business, but I haven't seen too many engineers that can translate that into entrepreneurship where it's like, hey, I don't have the answers right now, but I know how to keep going. But versus like engineering minded people, they just got to have all the answers. So it's perfect. And they never end up going. And that's just what I've seen, right? If you're an engineer, I'm not there insulting you. I'm just saying. So do you think that you were just being an engineer to make money, or do you just have this super innate ability to be analytical and take action? Is what I'm saying kind of makes sense?
Yeah, and I appreciate that. Yeah, no, I most of my buddies from college are exactly that. So I totally agree with you. They will not stop. Like the first level of what they get done is good enough. They don't have to keep going and not take action, but they will keep going until it's perfect, and the opportunity will pass by. They'll never do it. So I don't know. I'm not super smart. I think that's part of it. Like I don't does that make, I'm kind of dumb, I guess. Like I don't think that intensely about things. And I think that's like obviously a con, but can be a pro in that you don't let things hold you back and take action. So I don't know. That's kind of a self-deprecating thing, but like I think part of like that's part of it. Like I don't think too deeply, and like I'm a little like I like risk, calculated risk, but I like risk, and I feel like some people who are engineers don't like risk, and if they do take a risk, they do the entire formula math stuff to figure out like how much I'm going to lose and all the decisions that make me not lose money and blah blah blah, and they get stuck. And I just kind of do the basic level. And I'm like, was going to do it, whatever. Like leaving my job, which was like a nice cushy job for the next 30 years. Like that was the risk. The risk was, I didn't do the math and figure out like my lifetime earnings or whatever. I was just like, I'm just going to do this. So I think like having a risk appetite, and that will balance out the nerdy side of like me thinking super, super deeply about problems or decisions before I jump in.
That's totally true though, because like we live in Texas, Austin, right? There's a ton of engineers, and a lot of engineers that I know be in their job for like 15 years, and they'll be complaining about how much money they make. And I'm like, why haven't you got a different job then? Like, there's millions of engineer jobs. You could make more money. You just chose to stay there because there's too many risks in your brain to do that, to jump, right?
Yeah.
So you're just more like an input creates an output. Let's see what happens. Like, I think we can do it. So I like it. Sam, dude, I love it. I love that you came on, man. I know you got things to do, presenting to do. Epic proportions, dude. 500 something properties is, I can't even think of that. Hopefully I'll dream about that tonight, but I appreciate you coming on. I know Austin does. And with that, I'll let Austin end the show for us.
All right. Thank you all for listening. Peace.
Thanks, guys. We appreciate it. Take care.